All right, so who can give me the formula for the duration net worth without looking up? Any takers? It's a simple formula if you think about it. I've had some actuaries say you can simplify my formula. I don't write formulas down as in their simplified form. I write them down so the formula looks like what I'm doing. All right. All right, so y'all don't know it. Well, so I'd pay 10,000 bucks if someone could do it. I might change my mind later, but no one wants to try it. Well, the simplest form, you're just going to take the duration of assets minus the duration of liabilities. That'd be the simplest form. Well, what's wrong with doing that? What do we know about assets versus liabilities? Are they the same dollar amount? Which is usually larger? Assets. So what do we need to do? We need to adjust duration of liabilities for what? Because they're smaller. How do you adjust for them? You just take the dollar in liabilities divided by the dollar in assets. That's pretty straightforward, right? You can say, well, duration of assets minus duration of liabilities, if that's zero, maybe I don't have any duration net worth except for my assets are larger. For my duration net worth to be zero, I have to have a longer duration of liabilities than assets because my liabilities are not as big. All right, so that's pretty straightforward. Anybody remember the last little part that we have to adjust for? The leverage, right? Assets divided by net worth. So it's not a difficult formula. You don't need a formula sheet on the exam. It's pretty straightforward. We're going to see a little bit later the dollar duration gap. We're going to use this later is how much of the swap do we need to buy so we get this number to zero? What's that duration gap between our assets and liabilities when we make all the adjustments? And I'll show you that formula is real easy. That's like the one thing on the exam that almost everybody gets right because it's just a really simple formula. All right. But fairly straightforward formula, not complex math. So what we're trying to do now is figure out the swap and how the swap is going to help us. So AAA is going to go out in the debt markets and they're going to borrow money at fixed rate at treasuries plus 125 basis points. But they don't want fixed rate. They want floating rate. So they're going to enter a swap where they pay SOFR to triple B. They receive treasuries. They receive 140 from triple B. And they end up paying SOFR minus 15, which sounds like a really, really good rate. And this is from last week. I gave you all of that in this little paragraph. If you end up with two S's or two T's, you know you did the wrong side of the transaction. So you shouldn't end up with that. So they pay out in their normal market, they pay treasuries plus 125, and that's fixed for 5 years. So whatever treasuries is today, whatever that yield is today, maybe that's 3.5%. They're going to take that plus 125, so they get 4.75%. That's fixed for 5 years. It will never change, right? They're going to they're going to pay SOFR to triple B. That's going to change every quarter. That's going to be up and down. If interest rates rise, they'll pay more. If interest rates fall, they pay less. But then they're going to receive treasuries. So that if treasuries are 3.5%, they're going to receive 3.5% for 5 years. It's never going to change. And they're going to receive 140 from triple B usually quarterly. So 1/4 of it. So, take 1/4 of that quarterly. And they'll end up, when they started borrowing at T plus 25, they'll end up, after they do the swap, borrowing at SOFR minus 15, which was cheaper than what they could have done if they borrowed themselves. How much cheaper? 25 cheaper. How did we get the 25? Y'all remember? The difference in that credit, the term structure of credit spreads. Essentially, the swap market set up to split that, not necessarily equally, I know other professors teach it the way I'm kind of doing it here, but when I did a swap, I had no idea triple B existed. I wasn't calling triple B. Who am I calling? I'm calling, well, I am triple A. So I'm calling the investment banker. Who's finding triple B? The investment banker, right? They're putting all this together. And they may not find triple B. They may have to just manage the book themselves on their own. So it sounds like, yeah, these two entities just split this 50 between them and they each save 25 bips. But I don't know triple B exists. I call JP Morgan, I call Morgan Stanley, and I say, hey, I want to do a swap. They just tell me what the swaps curve is. So this is, I don't know if y'all realize there is a swaps curve. Y'all know what the treasury curve is, right? That's all the interest rates on the treasury curve. There is an actual swaps curve. It's an official curve. That's the rate you're going to get. So you don't negotiate it. The investment bankers aren't like, wow, triple B, you're kind of risky. I'm going to charge you this. They're actually giving you whatever the swaps curve is. So there's a given curve, and that's what the rate is, and that's just what it's going to be. So yeah, I mean, it's in fact, strangely, several years ago, I can't remember what market it was. It was during some crisis. The swaps curve actually fell below the treasury curve, which is really weird. I think it was back when the Republicans and Democrats were actually debating about shutting the government down and not paying the debt, and S&P downgraded the treasury. And some people, and one of my students pointed out that swaps have all this collateral, and maybe that's why they were looked at as safer than treasuries. But then he pointed out most of the collateral for swaps is treasuries, so they're shouldn't come below the treasury yield curve. That doesn't happen very often. We're going to talk about long-term capital management here. They went insolvent in '98. That's when the swap curve shot way up. The spread between the swaps curve and treasuries curve gapped out to a really wide level. But it's its own curve. It's its own interest rates, just like treasuries. Usually a slightly higher level than treasuries. All right. Now here's the part that's so hard to explain. I don't know how to explain it. But let's say they borrowed $500 million fixed. So when they borrow $500 million, they receive $500 million and they start paying interest on that immediately for 5 years. What did it do at the end of the 5 years? They got to pay the $500 million back. All right. This is the normal borrowing. Nothing unusual with that. You just go out and you syndicate the loan, you borrow 500 million. On the swap, the 500 million, and you gotta know this term. What do we refer to the 500 million on the swap? What's that term? Starts with an N, if that helps you. It's two words, an N and a V. Does that help you? What did Catapacum call it in his class? Note takers? You heard this term? Notional value. Extremely important number. Man, it's really hard to explain. So on the swap, when you do the swap, you don't actually receive or pay 500 million bucks, but you pay interest as if there was $500 million. So the notional amount is simply the amount that they're going to base those interest rates on. All right. You never pay it. You never receive the $500 million. It's just notional. And you have to be real careful. The press loves to report notional values because they're massive. They're trillions and trillions and trillions of dollars. If you take all the notional value for all the swaps out there, it's bigger than all the economies and stock markets in the whole world by a large factor. It's a massive, massive, massive number. But it's somewhat fictional because no one ever pays those two numbers. All right. So it's simply it's the number you need to apply that to. So triple B needs, they're going to be paying SOFR, but how much are they going to pay? Well, the notional amount's 500 million bucks, so they're going to take $500 million times whatever SOFR is, they're going to pay that every quarter. All right. So notional amount's very important because it tells you what those cash flows are going to be, but you never pay the 500 million bucks. We'll have to figure out how much of the swap we're going to do, how much that notional amount is. What is the market value of the swap at execution? What market value do you have? When you enter this thing in, the second you enter it, what's the market value? Any guesses on that? It's the same number for every swap. So what would you think? No, it's the same exact number for every single swap. Same thing with futures. What's your market value when you enter a future? 0. All right. When I did my first swap, the accountants were like, what do we do? You did this multi-billion-dollar transaction, but the market value is 0. What do we enter? And they're kind of confused. How long is it going to be 0? Or like a split second, right? As soon as interest rates change, it's going to change in value. So the exact same thing with the futures. You enter a futures contract, it starts off with a value of 0, but then as the different parts of it change, so and this is the hardest part of all, if they're paying floating and receiving fixed, what happens to the market value if rates fall? They're paying floating, they're receiving fixed. Does that sound good if interest rates fall? Do you want rates to fall if you're paying floating and receiving fixed? That's good. That sounds good. So what's the market value going to do of this swap from AAA standpoint? They're paying floating, receiving fixed. AAA market value increases from 0 to some number, as if they had a $500 million investment in a 5-year treasury. That's how their market value is going to go. All right. What about triple B? What's going to happen with them? Interest rates fall. They're receiving less for AAA, but they're still paying the same amount. They're going to see a market value loss. So AAA's gain is triple B's loss. Exactly offsets each other. Right? You can get more comfortable as we do this over and over again. Let's finish the problem and then work a second problem so you get a little more practice. Then we'll work a third problem, and then we'll probably in class work a problem and see if anyone can get it right. I don't think y'all can, but we'll see. I talk trash enough. Maybe someone will come in prepared. Maybe I'll bring my checkbook, pay out 10,000 bucks. I haven't done it yet. Right. So this is just a real simple question on the exam, but some people talk. We noticed that both AAA saved 25 basis points. Triple B saved 25 basis points. They both came out ahead by splitting that difference. You may sometimes hear this referred to as interest rate swap arbitrage. Arbitrage means you have a gain without any investment, without any risk. So you invest 0 and you have a return. That would be really nice, right? You invest 0 and you make 10,000 bucks risk-free. I would do it as much of that as I could possibly do. But the question is this really arbitrage? Is there really no risk in this transaction? And it's not truly arbitrage. And it's not arbitrage because there's a third party in this transaction between triple B and AAA. And that's the investment bank. So I'm calling up, I use JP Morgan, Morgan Stanley. I'm calling them up and saying, hey, I want to do the swap. And my exposure is actually the Morgan Stanley and JP Morgan. It's not to triple B. I don't really care what happens to triple B. I have no claims on triple B. My claim is on the investment banker. Like the first swap I did was where AAA is, and interest rates fell a bunch, and that swap jumped up from 0 to like 450 million bucks in just a few years. All right, so someone owes me 450 million bucks. Who owes me that money? was JP Morgan. What happens if JP Morgan goes insolvent? Well, I have collateral. That's good. If the market value is 450 bucks, 450 million bucks, they probably have $475 million in collateral sitting there. But what's my risk? Well, my risk if interest rates drop really fast, now they owe me $700 million and they can't get the collateral there because they're insolvent. So my risk is to, have y'all heard this term before? Counterparty risk. So my risk is to that counterparty, JP Morgan or Morgan Stanley, that when they owe me money, they go insolvent. If I owe them money, I'm not so worried about it. Right? They go insolvent, I owe them money. It's like, well, maybe they'll lose my paperwork. It'd be kind of nice. And if you have a mortgage with a bank, are you worried about that bank going insolvent? Doesn't bother you that much. You're probably not going to lose your mortgage. It's going to go to somebody else. But you're worried when they owe you money. So this is really interesting. This is a form of credit risk, but it's a very peculiar type of credit risk. So if someone loans you, or if you loan someone 10 million bucks, they go insolvent, you're in a lot of trouble. But it's one way. You're loaning them money. If they do well, you're happy. If they go insolvent, you're unhappy. But it's always one way. You're exposed to them. With the swaps, sometimes you owe them money, sometimes they owe you money. So it can shift around. And so you have to be careful to think through what could happen to this swap. So it is possible that even when you owe them money, you still have exposure. Why? Because interest rates can change fast. So maybe the swap is 50 million to your detriment. You owe them 15 million bucks. But interest rates could shoot the other direction really, really fast, and suddenly they owe you money. So even when you owe them money, you still have exposure because interest rates could change really, really quickly. There's a term for this. It's your exposure is measured as, it's called potential exposure. It's very different than other kinds of debt. You loan someone 10 million bucks, what's your exposure? It's 10 million bucks. They owe you 10 million bucks. With a swap, it's not quite like that because sometimes they owe you, sometimes you owe them. So we call it potential. What does potential mean? It's not what I owe them right now or what they owe me right now, but how much could they owe me if things really change in 3 or 4 days? It's that potential exposure, right? And you can probably Google that. Swap potential exposure and get some discussion on it. Even ChatGPT, see if they can figure it out. So essentially, how would you measure potential? Anybody have an idea how you might measure potential exposure? And if I tell you it's one of your measurements under price risk, your bank one paper, what do all banks use? Measure risk. You remember that term, value at risk? So when we measure potential exposure at UTSA, we did value at risk, which is what? It's a statistical thing. We run a bunch of scenarios, say, hey, what's the most we think they could owe us over the next 7 days if interest rates really change a bunch? And that's what we're going to set up as our exposure to them. I may owe them 50 million bucks right now, but if things really change, they could owe me 150 million bucks. So my potential exposure is 150 million bucks. How would I set up my value risk? I might run a 1% scenario. So 1% of the time, JP Morgan could owe me 150 million bucks. So I'm going to set that up as my exposure to JP Morgan. Very, very different than if I loan JP Morgan 15 million bucks, what would my exposure be? It'd be 15 million bucks. It's pretty straightforward. But with swaps, you have to do a little bit of an extra analysis. It looks like ChatGPT did a pretty good job on this one. Provides the bank an estimate of peak credit exposure over the life of the swap contract for a specified confidence level. That's what value at risk is. Many ways to calculate it. The way I calculated it is I got historical interest rates, something to look like SOFR, the 10-year treasury, and I just say, hey, how could the short-term rate move versus the long-term rate? So I could see what could happen to what they would owe me versus what I owe them. It's pretty easy to do. You just kind of go out and do scenarios. It's pretty easy to get historical interest rates. underwriting swap exposures. There's potential future exposure definition calculations. You can look, you can see it's scenario analysis, right? You can just see they run a bunch of scenarios. So it's not that complicated to do. All right, any questions on that? Looks like I talk about it a little bit more below. I have a schematic. I think I'll show you maybe next class. I want to get through a problem first. It really is a phone call to an investment bank. So I'm making it a little bit artificial by having triple B in here because you really don't care about triple B. All you care about is the swaps curve. You just go out and see what's the current rates and they'll tell you, the bank will tell you, and all of your exposure is to that investment bank. So in 2008, if you had a swap with Lehman Brothers, you're pretty nervous. I'll talk a little about, because there were some unusual things that happened in 2008 that if you weren't paying attention, it could have been pretty bad. All right. Now the tricky parts. So remember, in the first part of the problem, we said the duration of net worth was 6.43 years and it was too high. The duration of net worth was too high. All right. So what did they need to do? So this is the part where you're going to have to really practice. Let's do this second one. If the duration of net worth is too high, so in this case, their duration of net worth was 6.43 years. Remember, the board said it needs to be less than or equal to 5 years. So the duration of net worth is too high. So what did they need to do? They need to decrease the duration of assets or increase the duration of liabilities. For our purposes, for banks, we're going to focus on the liability side. You're going to see when we do pension plans, we flip over to the asset side, but we want to increase the duration of liabilities. How do you increase the duration of liabilities? You swap from floating rate debt to fixed rate debt. Right? Floating rate debt has a 0 duration. Fixed rate debt has a 4 or 5 year duration. So if you want to increase the duration of liabilities, so remember the formula. We want to reduce this number. It's too high. Then we need to increase this number. Right? See that? We're trying to reduce duration of net worth. To do that, we've got to increase the duration of liabilities. Right? How do you increase the duration of liabilities? You swap from floating to fixed. You were borrowing floating, which has very long duration. You swap from floating to fixed, which is increasing duration. Isn't that what triple B did? Triple B started off borrowing floating. Where did they end up after the swap? They ended up fixed. So you want to be on triple B side of this transaction if you were the bank with the duration of 6.43 years. All right, I can tell from y'all's expressions it's not sinking in yet, which it shouldn't. This is, some of y'all might have had this before, but it's going to take us a few problems to get used to it. But can you think of a question on this? Or you just need to let it sink in? Everybody understand how swapping from floating to fixed increases the duration of your liabilities? Kind of see that?
You go over again. How does that?
All right, so maybe the best way is to think about it in this formula. If we want to increase this number, you want to increase this part of it. If you want to decrease this number, you want to increase this side, all right? So the increase the duration of net worth, increase the duration of assets. To reduce the duration of net worth, increase the duration of liabilities, all right? So how do you increase the duration of liabilities? You enter a swap to go from floating to fixed. You started off floating rate like triple B. They were paying floating rate. They received floating rate from AAA, and And they paid fixed to AAA, so they start off in floating, they ended up in fixed. I think it's going to start sinking in after you do a couple of problems. You just got to get some practice. So if duration net worth is too high, you want to either decrease duration assets or increase duration liabilities. We're focused on the liability side, so we're going to increase the duration liabilities. So you want to go from floating rate. Floating rate's what you started off in, and up fixed rate. That's where you are after the swap. If your duration net worth is too low, if it's negative even, you either want to increase duration liabilities or decrease duration liabilities. We're on the liability side for banks. So here you would want to swap from where you started off fixed rate and end up floating rate. That's where AAA was. One thing I recommend you do when you finish the first part of the problem is you set this up in your answer so you're ready when you go into the swap to know which side you're going to be on. All right, let me give you the last part of the problem, and then we'll work the whole problem, work a problem completely again so you can get some practice. And this is a real life problem. If you walked into Silicon Valley Bank, you could have sat down and fixed the entire bank with one phone call, and you could have saved a lot of hassle and problems for the bank. All right, so dollar duration gap analysis ask how much of this swap do you need to get the duration net worth exactly the zero? All right, and it's a really simple formula. The duration of assets was 4.42 years. We have $1 billion in assets. If you go back to the original problem, way back up here. Duration of assets, we had $150 million in cash with a zero duration, 850 in auto loans and other things at 5.2. They gave us a duration of assets of 4.42. We have $1 billion in assets, 750 in liabilities with a duration of 375. Just to remind you of that problem. So the dollar duration, you take the duration of assets times the dollar amount of assets minus the duration of liabilities times the dollar value of liabilities. That is your dollar duration gap. So here we had duration of assets was 4.42 years. We had $1 billion in assets minus 3.75 and had $750 million in liabilities. That gave us a dollar duration gap of 1,607,50. So how much of the swaps should we put? What's our notional amount? It depends on what the swap is. In this case, they're giving us a swap with a 5-year duration. So we take our dollar duration gap, divide by 5. The notional amount we want in this swap is $321,500,000. If you put the swap, if Triple B buys a swap where they're going from floating to fixed and they do 321,500,000, the duration of net worth will go exactly to zero. You can test it in the formula if you want to, but it goes exactly to zero. Gets your duration of net worth to zero. This is what I did with USAA in the pension plan. I took the duration of our assets times our assets minus duration liabilities times that. I got a dollar duration. I called my broker. He said, man, the swap curves looks really good around 5 years. The duration's whatever. I take my dollar duration, divide by his swap, and I say, yeah, I need $321,500,000. The call could have taken less than a minute. Says, Ron, I really like the swaps curve out at 7 years. The duration there is 6.2. I take my dollar duration gap, divide by 6.2, and I say, yeah, that's how much I need in the swap. It's that simple with one phone call. Remember, the other alternative was to call your sales force, tell them sell more 5-year CDs or do more 10-year auto loans or whatever. Which would you rather do? This is pretty simple, isn't it? Pretty straightforward. I will warn you that dollar duration gap analysis is almost entirely used by pension plans. Banks and life insurance companies don't really use that term, so this is more of a pension plan. Banks could use this concept, but you won't hear them say that often. I'd say questions, but my guess is we just need to work another problem, right? Start from scratch. Before we do that, someone give me the formula without looking at your notes. Someone surely is able to do it.
Duration factor minus duration minus L over A, duration of liabilities. Then there's leverage at the end.
What's leverage?
Yeah,
Net worth. Y'all got it, right? I'm not offering you 10,000 anymore. You had to do it 30 minutes ago, but pretty simple formula. Yeah, can you simplify it? Yeah, you could simplify it, but why simplify it? I like this approach, shows exactly what you're dealing with. The board's going to give us a range. They're going to say it needs to be greater than or equal, say -5, or less than equals, say 5 years. What's the board telling you? How much exposure we're willing to accept to interest rates? We're willing to take some risks. So you think rates are going to rise or fall, you think they're going to fall, then go out 4 years, go out 5 years. You think they're going to rise, can go -4 or 5 years. But we don't want you going out 10 years, 20. We don't want you betting the whole firm on your ability to predict interest rates. So the board's going to give them a range. At USAA, we had not so much a range, but we measured it every quarter, see if our exposure was getting larger or smaller. And it was quite valuable. I'm going to talk about USA's pension plan and what we did there because of what our CEO was doing. He thought he was reducing our exposure to interest rates and he was actually increasing it. And I had to show him some data to say, man, we're going the wrong direction. You're betting on interest rates rising because if they fall, we're in a lot of trouble. He was making a one-directional bet that rates were going to rise, and I was like, yeah, that may not happen. All right, so the board's going to tell you something, and you're going to do this calculation. If you're too negative, you're going to need to reduce the duration of liabilities. If you're too positive, you're going to have to increase the duration of your liabilities, but we'll practice it. So this is what we're going to set up. So let's work another problem. All right, so this firm has $200 million in cash, duration of 0, almost by definition. They have $900 million in loans at 3.3. That's getting a little more normal. That kind of sounds like an auto loan. Remember, auto loans, what duration does a 5-year auto loan have? It has a maturity of 5 years, but what is its duration? I mean, more like 2.5 years, right? Because it's amortizing. Remember, duration is measuring all the cash flows, including principal. So 3.3 is still kind of long, especially if they have credit cards, because remember, credit cards have almost no duration whatsoever. But anyways, it's a lot shorter than the previous bank. Their debt or whatever deposits have a duration of 3.9 years, and they got 950 in there. All right, the first question is, what's the duration of their assets? Duration of their assets is just going to be the weighted average of the two pieces. So you can do 200 over 900 times 0, or you just ignore that part because that's obviously 0. So you can just say, I'm sorry, over 1100. Or you can just say 900 over 1100 times 3.3. You really can just say that. You can ignore the 0 part because you know that's 0. That's the duration of their assets. So duration of assets is 2.7 years. What's the duration of their net worth? Duration of assets minus liabilities over assets in dollars times duration of liabilities times assets in dollars, net worth. So asset duration is 2.7 years. You just calculated that. 950 divided by 1100 times 3.9. All of that times 1100 over 150, and duration of net worth is negative 4.91. Duration net worth can be a negative number. Essentially, they make money if rates rise. That's the unusual one. Usually you want to make money when rates fall and you lose money when rates rise. They actually make money if interest rates rise. This is probably the position Silicon Bank wishes they were in. Instead, they went the other direction and betted on rates falling. What if interest rates were to rise 200 basis points? Remember, 200 basis points is what? It's 200 divided by 10,000 or 0.02. So make sure you can talk in basis points. I tell my investment class, don't even say basis points, just say bips working into an interview. It's a really common term.
That just means no other durations, so that's total assets.
Yeah, the duration of this 1100 is 2.70. I didn't give that to you, but you calculate it because it's just a weighted average of these two pieces. Is that your question? Okay. And I could give you that, but you have to calculate it. In reality, like at USA, it was every auto loan, every credit card, they actually went in detail on the liability side, every certificate of deposit, every savings. And the hardest part, we talked about this last class, the hardest part were the saving and checking accounts. It's really hard to figure out the duration of savings and checking accounts. All right, so we actually got a negative number. What would happen to their net worth if interest rates were to rise 200 basis points? So this is the other formula you have to know. The exposure to interest rates equals minus duration times the change in yields. This formula everybody in finance should know that formula. It's one of the most famous formulas. That's almost as famous as the capital asset pricing model. Minus duration times the change in yield. Really, really important formula. So minus duration, if you look at the way I do it, I'm real careful. So the minus sign is in the formula, and then I write duration inside. If the duration was positive, I would have written minus, open parentheses, plus whatever. But here duration is negative, so minus duration of assets, which is minus 4.9, times the change in rates. Rates are up 2%. That means their net worth, if interest rates were to rise 200 basis points, their net worth would have gone up 9.82%. All right. That sounds good, right? But what else could happen? Interest rates could fall 200 basis points. What if interest rates fell 200 basis points? Then their net worth would have fallen 9.82%. Can JP Morgan afford to lose 9.82% of their net worth? You remember, we looked at their numbers. They have more than $10 in assets to every $1 net worth. And so if their net worth were to fall 9.82%, they'd essentially be insolvent. So they don't have much room here. So if you want to immunize the balance sheet here, you would need to raise the duration of net worth by decreasing the duration of liabilities. How would you do that? You would start fixed rate and end up floating. The exact opposite is what we saw last one with triple B. Here you want to be on triple A side. You want the one that starts fixed rate. Remember, triple A started fixed rate because they have that competitive advantage on fixed rate, but they swap and end up on floating rate. This isn't part of the answer, but this is what you want to be thinking about. So questions up to there. Feel comfortable 1 and 2. We're going to be working more problems, but you should be getting a little more comfortable now. All right, let's figure out the swap. So AAA can borrow fixed rate at Treasuries plus 50. Triple B, Treasuries plus 150. Sorry, I should have done a search on the word LIBOR. Anybody know what LIBOR stands for? That's probably been completely forgotten. London's enter
Innovate.
Offer. You got it. What's the R?
Rate.
Rate, yeah, London interbank, so it's between banks. Offer rate. So what does SOFR stand for? I don't even know if I know that one. SOFR is after my time. Anybody knows SOFR? R is probably the rate. Overnight financial rate. Yeah, that makes sense. It should be a short-term rate. All right. So what's the first thing you do? You type the word difference here, right? What's the difference here? 100. What's the difference here? 150. Now this one's incredibly unusual, and I won't give you one like this on the exam. Almost always, the higher quality one is going to have a bigger advantage on fixed. So this one doesn't really make sense. There's something weird going on here. So I won't give you a problem like that. I almost want to delete this problem because I don't like that. But yeah, it's really unusual. Why would you want to charge AAA more for floating rate when it's the higher quality entity relative to triple B? Doesn't make sense. But you have to put that difference in. So the question is, who has the comparative advantage in fixed rate? What do? Wherever the number is bigger, that's where AAA has the advantage. So where does AAA have the advantage? In floating rates. So where does triple B have the advantage? Fixed rate. Every problem I'll give you going forward, AAA is always going to have the advantage on fixed rate. That just makes more sense, right? Huh? Well, if it was exact same spread, that would be kind of strange. The swap really wouldn't do anything for you. But traditionally, I think 100% of the time, this number is going to be bigger than this number. All right. I gave you a problem that's a little bizarre. Because the triple B is really weaker, you're going to charge them much more for a 5-year loan than you will for a 3-month loan. But yeah, I don't like this problem the way I have it set up. So you might say, well, the triple B doesn't have advantage in fixed rates, but we're talking comparative advantage. They're less disadvantaged than fixed rates, so that's where they have the comparative advantage. All right, so that means triple B, when they borrow money in regular markets, triple B is going to borrow in fixed rate. And their normal borrowing, and they're going to borrow in fixed rate because that's where they have the comparative advantage. Yeah, going forward, AAA is going to have the advantage. That's just the nature of it. All right, so if we look at the swap, AAA is going to borrow floating at LIBOR plus 10, or I mean SOFR plus 10. Triple B is going to borrow where they normally would borrow, which is going to be treasuries plus 150. That's just normal borrowing. There's nothing unusual. There's no swap there. This is borrowing money. Now they're going to do the swap. The swap is going to be AAA is going to pay treasuries plus 15 basis points to triple B. Triple B is going to pay SOFR to AAA. So AAA pays T plus 15, receives SOFR. Triple B pays SOFR, receives treasuries, receives 15 basis points. What's the ultimate borrowing cost? So they started off paying floating plus 10, but they received floating. So the floating cancels out. And then they pay triple B treasuries and they pay triple B's 15. So they end up paying treasuries plus 25. Everybody see that? If you end up with 2 S's or 2 T's, then you started in the wrong spot here. All right, you got that backwards. Everybody see how I did that? So they pay floating, so their exposed interest rates going up and down, but then they receive floating. So they're pretty happy about that. Floating disappears. They're paying treasuries, and that's going to be fixed for 5 years, and they're going to pay 15. So when you do all the math, cancel out the S's, you have T plus 15 plus 10, you have T plus 25. Triple B is going to pay T plus 150, but they're going to receive T from AAA, and they're gonna receive 15 from AAA, so the T's will cancel out, and they end up with SOFR plus 135. T plus 25, what were they paying before? T plus 50, so they saved how much? 25. What did SOFR, what did triple B end up with? L plus 125, what were they paying before? Or S. S plus 135, they were paying S plus 160. How much did they save? 25, where did 25 come from? The difference in the two spreads. Right?
So in any situation where it's not split evenly, does that make sense?
Well, I don't think in practice it's the way we set up the problem, but remember, I don't know if triple B exists. And this is assuming every triple B company pays the exact same interest rates, but that's not true. So I know that's how it's taught in the textbooks. In reality, you don't really know and you don't really care because your dealings is entirely with the investment bank. You don't even know triple B's out there, and triple B may not be out there. This might be triple A doing 500 million, and there might be 5 companies doing 100 million on average. It can be all kinds of companies. So there's a whole lot of things going on. Textbook makes it real clean doing it this way, and it makes it much easier on the exam. In reality, it probably works out about that way, but it's probably not precisely to the basis point that perfect. All right. So determine which side of the transaction. So let's work. This is the hardest part. We want to immunize their balance sheet, which means we want to take the duration closer to 0. So we need to either increase the duration of assets or reduce the duration of liabilities. So we want to reduce the duration of liabilities. How do you get the duration of liabilities lower? Do you swap from floating to fixed or swap from fixed to floating? You swap from floating to fixed, what are you doing? You're taking really low duration and swapping to longer duration. What's that going to do? That's going to increase the duration of liabilities. You start off in fixed and end up in floating, what's that going to do to duration of liabilities? It's going to reduce it, right? You started longer term, ended up short term. And so which side do they want to be on? They want to be on the one that started off in fixed and ended up in floating. And that's triple B. Triple B, because we need to decrease the duration of liabilities, increase the duration of net worth. So swapping from fixed to floating will do that. This is the part you can probably have to spend some time letting it sink in. On my CFA exam, remember, I didn't get an interest rate swap. I got a currency swap, which is a million times worse. It's like I had all my fingers and my toes and it wasn't enough. It just gets so confusing for me for currency swaps. But interest rate swaps, it's kind of become a little more normal. It's easier for me to think through interest rate swaps. But let this sink in. If it's not sinking in, come talk to me and we can find another way to try to answer it for you. But the key here is we're dealing with duration liabilities. And when duration liabilities is too low, when duration net worth is too low, you want to increase duration of assets or reduce the duration of liabilities. So you have to think through what reduces the duration of liabilities. And if you're going to go from fixed to floating, fixed is longer duration than floating. So if you go from fixed to floating, you're reducing the duration of liabilities and you're getting your duration net worth. Be real careful on your answer because I get this a lot. Let me go back to the previous question. I see students say this. Let's say on this one, duration net worth is too high. So we want to reduce the duration of assets or increase the duration of liabilities. But what I get some students say is, I want to be on triple B side because we want to reduce net worth by increasing liabilities. Is that what they're doing? What are they actually doing? Are you reducing net worth? You're not reducing net worth. What are you reducing? The duration of net worth. And you're not increasing liabilities. What are you increasing? Duration. Be careful on that. Don't, hey, we want to reduce your net worth. That's not going to be a good sales pitch. So it's the duration of net worth, the duration of liabilities. So in this case, well, in both cases, they want to be on triple B side because I switched triple B to have the comparative advantage on the other side, which is a little weird. All right, so using dollar duration gap analysis, if they want to get the duration of net worth, not get their net worth to zero, but to get the duration of net worth to zero, what do they need to do? So remember the duration of their assets is 2.7 years. They have 1,100 in assets. Their duration net worth is 3.9. They have 950 in assets. They want to have, now you might get a positive or a negative number. You can ignore whether it's a positive or negative number. So use an absolute value. All right. Why is that? Because the positive or negative you've already answered. If they're going from fixed to floating and it's a negative number, they're going from floating to fixed. You don't have to worry about it. You've already decided I want to start off fixed and end up floating. You'll just do that. So don't worry about a positive or negative number. You just need to know the notional amount. So 735 is your dollar duration gap. You have a 10-year duration interest rate swap. So 735 divided by 10, your notional amount is $73.5 million. It's going to be a fixed to floating. That's how you get that negative number. Now think about it. The duration of the previous problem was 5 years. So our notional amount would have been twice as much if we did a 5-year swap. Here they're doing a 10-year swap, so their notional is half as much. You can see why when the press reports notional amounts, they're kind of meaningless numbers, because it just depends which duration you chose. So what did I do at USAA? Well, one thing at USAA, let's think about this problem. I'm paying T plus 15 and receiving SOFR. That's going to happen every quarter. Sometimes I've got to pay, sometimes they're going to pay me. And I was thinking, man, I don't want to do that. That's kind of a pain. And my swap dealer says, well, we do have a 30-year zero swap. So that sounds interesting. So in that case, I don't pay any interest. The only thing that gets swapped back and forth is the SOFR. And it's a 30-year, I mean, I said, that sounds great, but my duration is 30 years. So that reduced my notional dramatically, but only because the duration was massive. My interest rate exposure was really high. So you can go all over the place on these numbers depending on which particular swap you pick. So it was pretty crazy. My swap was 5 years, but it was based on a 30-year zero coupon. I mean, you can get really crazy in these transactions. You can kind of create whatever you want to create. You remember we talked about futures and forwards. Futures are over the, I mean, as forwards are exchange traded, forwards are over the counter. So forwards, you can do your own kind of deal and your own terms. Well, swaps are over the counter. So you have a lot more flexibility on kind of how you want to structure it. And I was pretty amazed. My swap dealer, I don't remember his name at all. I was a little nervous the first swap I did. I was like, I've never done this before. Hopefully I know what I'm doing. But he was really good. But I was telling him, man, I don't want this pain of sometimes I owe them money, sometimes I owe me money. I say, how I can fix that? Let's just do a zero coupon. So, man, that sounds good to me. Let's do that. So you can get pretty creative with these. All right, so let's talk a little bit more about this interest rate swap arbitrage. Is it really arbitrage? And counterparty risk is a term you can look up in Google or wherever you look up. So why is it not just called credit risk? Why is it called counterparty? It really is very unique because the values we owe each other can change so much, but it is credit risk. It is the risk of default. What you need to do on the exam is distinguish it from credit risk. Normal credit risk, one party owes the other and that never shifts. That's always one direction. But with swaps, each party can shift which side on the transaction they are, and it can switch pretty quickly. So counterparty risk is a risk that the other party in financial transaction may fail to fulfill their contractual obligation. Now remember, there's collateral sitting there, but that doesn't protect you precisely, because usually the collateral is like 102% of the market value. So if their market value, they will use $100 million, the collateral is only going to be 102 million. And think about 2008, these things were moving fast. Interest rates were moving fast. So Friday, they may owe you $100 million, but on Monday, they may owe you $500 million. It move that fast. And if they're insolvent, they're probably not going to get the extra 400 million. You know, your bank's going to call them and say, hey, we need $400 million in collateral. And they're like, get in line. The whole world. If you're Lehman Brothers, you call Lehman Brothers on that Monday after they went insolvent and say, hey, we need another 400 million bucks. They're probably not even going to answer the phone. It's like, yeah, we're not sending you anything. That's not your money. Now, you might ask, you got this collateral of 100 million bucks and Lehman goes under. Do you get that 100 million bucks, or do Lehman's creditors say, hey, we also want that 100 million bucks? As far as we know, that 100 million bucks is your money. Now, we don't know if it's been perfectly tested by the courts, but as far as we know, you're protected. That 100 million bucks is your money. You get it. The other creditors can't come in and say, hey, we want our hands on that money. But it's possible. Creditors, I mean, if you're a Lehman Brothers creditor, what would you say? I want my hands on any money I can get, including that collateral sitting in a credit default swap. But so far, we believe that that's well protected. But that's what counterparty risk is. Why is that important? Well, you might be surprised you have counterparty risk and haven't thought about it. So if you're buying some of these strange ETFs, exchange traded funds, that may be doing oil or doing gold or doing some currencies, you might discover that they're not actually buying gold. They're not actually buying oil. They're probably doing swaps. And they have tremendous counterparty risks. So some of these ETFs, The Economist wrote an article about this a few years ago. Some of these exchange traded funds have tremendous counterparty risk. So if Lehman or Morgan or Merrill goes under, you might think, wow, I got this wonderful portfolio. It's when gold prices soar, I'm going to make all this money. Well, if they're doing it through a swap and the person on the other side of swap with all your gains in gold, they go insolvent, you may discover that your exchange traded fund doesn't pay off. So it can be a significant risk. It can be pretty dangerous when values change dramatically. So the investment bank is the key. There aren't that many investment banks out there. Now, if we talk about this, if the counterparty owes you money, does that mean you have no risk? The answer is no, because interest rates could change. So maybe they owe you $100 million on Friday, but you owe them $100 million on Friday, but on Monday they owe you 200 million bucks. It can shift that fast. So you still have to do that potential exposure. And it's essentially a theoretical number that there's some probability between now and the next few days, we could go from me owing them money to them owing me money. And how much could that be? How much would I set aside? And again, it's a statistical thing. You might look at a 1% chance, a 5% chance, just depends on what you're looking for. Most banks have netting arrangements. You might search on the bank you're doing for paper one. You might search on the term netting arrangements. What does that mean? That means if JP Morgan has like 12 swaps with one entity, they're allowed to net all those together into one exposure. So they may say, hey, 3 of them, they owe us money. 4 of them, we owe them money. What they're allowed to do is net them all together so they reduce their exposures. That's a netting arrangement. And banks do that quite a bit because they deal with some pretty big customers that have multiple swaps with them. What they don't want to have happen is the ones where their customer owes them money, they lose money on that, but they got to keep paying the ones where they owe them. They don't want to do that. They want to net them all together to reduce their exposure. So a netting arrangement is not, it's a mitigation, but a mitigation for credit risk, not a mitigation for price risk. So it won't be part of your paper because you're not doing credit risk, but netting arrangements is a mitigation. And all banks do it. You'll see it. All big banks do that. But yeah, value risk is the most common way to calculate that potential exposure that you have. So what happened at USAA? I mean, this was interesting. We had two swaps in 2008. They were up like at the max, I think 500 and something million bucks. It's one of the best transactions I did, right? I bought something for zero and it's worth 550 something million dollars. The problem is one of them was with Morgan Stanley. Remember Morgan Stanley, if Lehman went under and Merrill Lynch went under, Morgan was going to go under. So they owe us a few $100 million bucks. I wasn't worried about JP Morgan. If JP Morgan went under, we're all dead. So it's like, don't worry about that. JP Morgan was going to be fine, but I was worried about Morgan Stanley. And I wasn't in that department anymore, but I called the guy who took my place. And I said, man, if I were you, I'll give you a couple of scenarios. So let's think about this. We're receiving fixed and paying floating. So what do we want interest rates to do? Rise or fall? You're paying floating. That kind of makes it easy. You want them to fall. So we gain if rates fall. We have a swap with Morgan Stanley. If Merrill Lynch doesn't get bought out by Bank of America, what do you think interest rates are going to do on Monday? So what happens? We're talking about a really high quality interest rate like treasuries. What do treasury yields and swap yields do usually in a crisis? If they fell, rates will fall a lot in one day, which means what's going to happen to my swap value on that Monday? It's going to rise. So high increase in swap value with a bankrupt counterparty. Well, that's kind of interesting because if you get out of a swap and they fail, your swap could have been worth $700-800 million, but they couldn't have paid you. You stay in the swap. Now your swap's worth 700 million bucks, but they can't pay you. Which of those would you rather do? So here's what I told him to do. He didn't do any of them, unfortunately, but I had trouble getting him. He was like, no, we're just going to sit with what we're doing. But so you could get out of the swap. So if they owe you 200 million bucks, say, hey, give us our 200 million bucks. We want to shut down the swap. You could do that and take your gain on Friday. The good thing there is if they're insolvent on Monday, you at least don't have exposure to them. But the problem is rates are falling and you needed that gain if rates fell. So you lost the gain. You could move the swap. I wish I could type to JP Morgan. That could work, right? I'm not worried about JP Morgan. So that would work pretty well. So what are the scenarios on the other side? So if they go bankrupt, rates will fall. I have all this money. That in that case, I'm glad I moved it to JP Morgan. That would be the best answer, right? So Morgan fails, interest rates fall. I'm really glad I moved the money to JP Morgan. So in that scenario, you don't want to be with Morgan Stanley. All right. So there's one. Morgan fails. Best answer, exit Morgan Stanley and move JP Morgan. Let's say Morgan does not fail. What are interest rates going to do on Monday if everything works out wonderfully? Rates rise, I lose money on the swap. In that case, you want to be with Morgan Stanley in that case? You're better off. So here, your best answer was exit swap and stay out. All right. So if they fail, you wish you had exited Morgan Stanley and went to JP Morgan. If they don't fail, you wish you had exited Morgan Stanley and done nothing. All right. What's consistent with your two scenarios? you exit Morgan Stanley. So that's obvious to me. So your only question is, do I exit and stay out and hope everything works out, and then I get back to Morgan Stanley on Monday, or to exit and go to JP Morgan? So you have one thing that's for sure, which is what? Exit Morgan Stanley. All right. Then you have a hard decision on the other side. What did my team do? They didn't do anything. They stayed with Morgan Stanley, and interest rates rose. They lost a couple $100 million on the swap. Of that next, I mean, from their gain, they went from like, 300 million to $150 million gain. You see how scenario analysis can really help you there, though. You look at those scenarios, say, okay, at a minimum, we're getting out of Morgan Stanley. Now we got to decide if we're going to bet on this weekend, what's going to happen. Lehman's going under. We're glad we don't have Lehman. That would look bad. I mean, you really, this one here, I mean, can you imagine going to your boss and your boss saying, hey, man, I'm sure glad we bought that swap because we're really worried about rates falling, and then they fell, and that swap, boy, that's got to be up in value. It's like, yeah, I got good news and bad news. We got a lot of money on a swap. Unfortunately, it's with Morgan Stanley, and as you could tell, that's not, you don't want to have that conversation with your boss. That's not a good conversation. So what would you have done in this situation? The JP Morgan or no is a pretty tough decision, isn't it? That would be tough to make. Would you maybe do half of it? Do part of it, not all of it? That's pretty tough to do. Why are you doing JP Morgan? Well, because to bring a third party in, remember you have to do that swap contract, and that takes 9 months. So you don't have that kind of time. You got a swap contract with JP Morgan. These things are incredibly fast. I can get my $200 million from Morgan Stanley like that. I can enter a new swap with JP Morgan like that. It's really fast. Once you have the contract set up, it's really fast. It's a phone call. But this is finance. This is what finance is all about, huh?
Would Morgan Stanley also have to agree to give the money, or is it like?
No, it's in the contract. Remember, I was reading that one paragraph with the lawyers. I said, I want my money from Morgan Stanley with one phone call in 10 seconds. And they said, that's what it says. They couldn't prove to me that's what it said because it's too many words. I said, yeah, as long as that's the case, that's what I want. The funny thing to me was USA wasn't that well known on the pension side. And so our two banks were like, well, this is USA. We want them to hold more collateral. And I said, you shouldn't be worried about USA. We've got a very overfunded pension plan. It's a AAA company. I knew they shouldn't be worried about us, but they were. And so I said, that's fine. You want more collateral? I want more collateral. And so I just said, that's fine. You hold more, I'll hold more. I was fine. Because I had plenty of assets to give to them. Y'all know the word hypothecate? Does that term sound familiar? I don't know if I spelled it right. Let's see if Bill Gates, yeah. So what does hypothecate mean? That's when you put assets over for collateral. You're essentially kind of putting them in that bin that's set aside for Morgan Stanley. So hypothecate assets. I didn't really care if I hypothecated assets. I had a $3 billion pension plan with plenty of assets. They wanted me to hypothecate 200 million instead of 180 million. And it's like, fine, throw some over there. Pretty easy. It's a huge advantage. When you as an individual do this, you got to set aside collateral. It can be a real pain. But at USA, when you work for a large corporation, I'll talk about the pension plan. Yeah, it's pretty, I mean, the property and casualty. If I needed $1 billion to hypothecate, I just went to Donna and say, hey, Donna, you got $1 billion in bonds I can borrow? Say, yeah, and you just put them in there and it's like no big deal. It's pretty easy to do. So you hypothecate. It's a lot easier than with individuals. So with insurance companies, we have assets sitting there for 5-10 years, billions of dollars. It's pretty easy to move assets over to hypothecate. And so Morgan Stanley, I can't remember if it's Morgan or JP Morgan or both, but they said, we're worried about USA. Can we get more collateral from them? I said, sure, as long as you give us the same on the other side. And I'm happy with that. But this is pretty exciting, right? That's kind of nerve-wracking, right? Would you go home that weekend? How would you feel that weekend? Should I have done JP Morgan? You know you should have gotten out of Morgan Stanley, but now it's which of those two do you? But this is what I love about finance. You got to make a decision. You got to look at the scenarios, try to figure it out. Would you flip a coin? What would you have done? But this is, if you don't like this scenario, you're probably not set up for finance, because this is what finance is all about. You say it with great confidence, even though your stomach is churning. You go home, you don't sleep a second that whole weekend. You're getting up at 3 a.m. to look at the news. I mean, that's the way it is. You'll have that sometime in your career. But at the end, you're like, man, that worked out well. You're pretty excited. If it doesn't work out, you're kind of not wanting to go to work the next day. Can you handle that kind of stress? That's where finance really hits. And it's huge for your company, you know, if you get it right or get it wrong. They just stuck with Morgan Stanley. Everything worked out. Interest rates rose, so they lost money on the swap. But I told them they should have gotten out of the Morgan Stanley because, and they were like, what? They were like not even aware anything was going on. I was like, come on, guys, pay attention, pay attention. This is your job. This is what you need to be doing. So, all right. All right, so what we need to do is work a couple more problems. So are y'all ready to work one in class on Thursday, or y'all need me to work another one? How far along? Could you work one with your notes on Thursday? I'm sorry, on Thursday? Y'all could handle that in teams? All right. Maybe we'll have teams and the team that wins gets 10,000 bucks unless I change my mind later. All right. So think about where you're most weak on this. Duration net worth, y'all got that down? Pretty easy. You know how to do the swap. That one takes a little bit of work. And then probably the hardest part is which side of that swap should you be on? That part you're going to have to kind of think through. Dollar duration gap, most people get that once they see the formula, pretty straightforward. So, all right, what we're going to do after this, and don't leave yet, but my favorite question, if you don't like it, feign interest and excitement because I'm so depressed. If we look forward on this, I think it's the greatest single question in finance. It relates to pension plans, but it's the question is, should you borrow to invest? So here's the question that we're going to address. I just saw a video of this guy saying you should always borrow to invest. He's talking about it from different perspectives. And I'll bring up AT&T because this is the firm I had the big debate with. Should AT&T go out there and they can borrow really cheap? So they go out and borrow $1 billion that's say 3% and stick it in the stock market to make 8%. Would the value of AT&T go up if they did that? Sounds pretty good, doesn't it? You borrow at 3%, stock market's going to make you 8. Would the value of AT&T go up? And I'm going to argue the value of AT&T will do what? Go down. And it's for several reasons. Capital asset pricing model, net present value. It's going to have to do with what you think about efficient markets and there's almost everything you've learned in finance. It needs to be used in this question. It's one of the essays on the first exam. It's a tough essay. If you understand this particular problem, you understand finance. So I have a blog that answers it, but what does that have to do with pension plans? Because what is a pension plan? The employer says, hey, I could pay you an extra 20,000 bucks, but you know what I'm going to do? I'm going to keep your 20,000. I'm going to put it in a pension plan and I'll pay you back when you retire. That looks a lot like borrowed money, doesn't it? You could have paid your employee today and said you're going to pay him in the future. What did you just do? You just borrowed $20,000 from your employee. What does AT&T do with that pension plan money? They stick it 70% in the stock market. They're doing exactly what I say destroys value. And why am I bringing up AT&T? Because that's the guy who says, I was an idiot for what we did at USAA. I thought he was an idiot for what they did at AT&T. I think for AT&T to have a massive pension plan and stick it in the stock market, that they're actually destroying the value of AT&T. But we can debate that and we'll see. It's a great question. Don't you wish the AT&T guy could be here? But I don't have his phone number, so I can't debate him. So I win the argument because he's not here. But I'm willing to take any of y'all on. So I'll get this blog to you. I'll let you read it this weekend. Keep working on your paper 1. We'll talk about paper 1 more and more. You got plenty of time for paper 1, but you need to be starting now. All right, we'll stop it there. 2 or 3 more minutes on A and B. Careful on B, it doesn't ask what the change in net worth is. It asks what net worth, what would this 150 be? So don't give me the percentage change or the dollar change. Figure out what net worth will actually be. So some people forget to do that last little calculation. Are y'all ready? A and B? Yes, no? All right, let's try. First of all, what answers did some of y'all get? 5.4. Any other answers? 6.4?
Negative 5.6.
Oh, 6.4. All right. Other answers? Anybody else get this number? 9. All right. Other answers?
I got 10.66.
6. All right. Other answers? How many think 9's the right answer? All right. Let's see. I don't know the answer because I haven't looked at the answer. Let's see. So what's the formula for duration of net worth? Duration of assets. So dollar liabilities or dollar in assets. All right. Yeah, dollar in assets, dollar in net worth. Be careful on the parentheses. So the first thing we got to do is figure out the duration of assets. Here, I just do 0.95 times 5. How did I do that? Because you can ignore the 0, and you know 95% of their assets has a duration of 5. So what is that answer? 475 or something like that? What y'all get? I can't do it in my head with people looking at me, but 475. So 4.75 minus 850 divided by 1,000. So y'all mind me just doing 0.85 times 4 times 1,000 divided by 150. So 4.75 minus 0.85 times 4 times 1 divided by 0.15. 9. Now, one thing you'll notice, this may be a little hint. I do try to give you a round number. Not always. It might be like 6.2. Probably won't, if you go out more in 2 decimal places, you might read, not gonna 100% promise you, but I do try to make it a little bit of a round number. It just makes it easier to do the other calculations. All right. Okay, no problem. No, I know you had the courage to speak up first, so that's good. And y'all, you're gonna have math errors. One thing on the exam, write all of this out. Because if you have a math error, but I can see you know the formula, you can get a lot of partial credit. Sometimes the anxiety of exams, you put the parentheses in the wrong place or something along those lines. So now if you get like 87 or negative 1200 or 0.21, that's probably going to be wrong. You have some sense that it's probably going to be a number where it violates the board's policy. So if you get like 2 or 4 or something like that, that's within policy, then you know, I'll say,
Well, here it is.
he's got one. All right. So some of it you kind of tell. Don't spend the entire evening on that one question if you can't get it. Go with the number, and if that number is wrong, then use it correctly the rest of the way, then you'll be good. All right. So what's the formula here for the percentage change? You remember this formula, one of the most famous formulas in finance. What is this formula? So times the change in yield, what comes first?
Negative.
Yeah, minus, and I always put it in parentheses, times the change in yield. Here, so minus, and then watch how I do it. I don't say -9, I say minus +9. The duration's positive, so minus +9. I'm real strict. So you remember to say that. So times the change in yield. What did yields do? They rose. What is 250 basis points? 0.025, right? Divide by 10,000. Everybody got 22.5? Does that sound right? So net worth would fall 0.225. So the ending net worth will equal beginning net worth 150 times 1 minus 0.225. I get 11625. So their net worth would have fallen from 150 to 11625. Everybody agree with that? So your answer on the first one is 9. Your answer on the second one is 116. But show the formulas so you can get credit. If you don't show the formulas, you don't have to off very far from me to not give you any credit at all, because I don't know how you got it. Could have been lucky you got 113.7 or something. I have no idea how you got it. But if you show the formulas, I can see there's just a math error. That's good. I don't need complete sentences. I had a finance professor count off because we didn't use complete sentences. It's like, okay, this is finance. But do show your formulas so we know. Any questions on those first two? The hard work is this. Getting these durations. Well, once you have the durations, the actual calculation of the exposure is pretty straightforward. That's the easy part. So whoever, I gave you the hard part and you're calculating the easier part, but this formula, you don't see it as much in finance. I think you should still know it because it's a pretty easy formula. This formula, every finance major knows this formula. So if you don't know this formula, don't memorize it for the exam. Just know it for the rest of your life. All right. It's really, really important. I was talking to an alum from this class. He actually went to law school. So if any of you are interested in law school and want to talk to him, let me know. He went to UT Austin Law School. But he remembers a lot of his finance. I encouraged him to become a lawyer that does interest rate swaps because it's desperately needed. And he's like, yeah, that's kind of interesting. I might do that. I was really impressed, man. He finished law school really fast. All right. Now, this is independent question B, but we do have part of the answer. Well, not really, because this is a rise of 250. Do you see 250 in the board's policy? So that's not going to, B is not going to help you at all. You could calculate each one of these, but start with question D. What is the board saying net worth duration can be? Duration net worth can be what? What's the lowest it can be? The absolute lowest can be negative what? Not 5. 7, yeah. We know the formula is minus duration times the change in yield. And they're saying minus duration times 0.01 must be greater than or equal to negative 7%. So that implies duration must be greater than or equal to negative 7 or less than or equal to 7. Do y'all see that? You can essentially just go to the 100. Whatever that percent is, that's what the duration is. It's that simple. All right, because that formula is just very linear, very straightforward. If the duration of net worth was 8 years, what would you get? Minus 8 times 0.01, you get negative 8%. Is that in the board's policy? No, it's too great. Don't forget the two pieces, though. A lot of students do the 7, but they forget the negative 7. So it can be as low as 7 or as high as, as low as negative 7 or as high as positive 7. Don't forget the two pieces, all right? Did they have trouble with rates falling in this case? Minus 200, what would happen? Their net worth would go up 18%. Is that in compliance? That's in compliance, isn't it? Right? The board said, hey, if rates fall 200 basis points, your net worth can't fall more than 14%. If interest rates fall 200 basis points, their net worth would go up 18%. So they'd be in compliance. Where are they out of compliance? What would happen here? They would lose 18%. They're out of compliance. What would happen if rates rise 100 basis points? What would they get? Someone tell me that. I can tell you all with me. Down 9%. See how you can do that formula in your head real quick. -9 times 0.01 gives you -9%. What happens if rates fall 100 basis points? How much? Say it again. Yeah, plus 9%. So they're in compliance if rates fall, but out of compliance if rates rise. Is it possible for a bank to be out of compliance, both rising and falling rates? Well, you'd have to be working really hard to do that. It is possible, but I don't think there's a bank out there that would do that. Most banks are either exposed to rates rising or exposed to rates falling, not both at the same time. Yeah, I've heard of a straddle or a strangle in option world. You can create something that you're in a lot of trouble on both sides if rates rise or fall. So what action? So this is a pretty complex question. So let's first start off. This is probably the most important question in here. So duration of net worth is what? Too high or too low? Too high. And you notice I didn't say net worth is too high. Don't tell me that net worth is too high. Well, I remember I was at UTSA, we were doing this analysis and I was running scenarios for our surplus. So my point was our net worth. So we had more than a sufficient net worth, essentially saying we had extra net worth. And I had this whole team of 20 or 30 of us came up with this. And we're just saying, hey, we run scenarios, we have sufficient net worth. Not realizing our CEO hated anyone saying we had sufficient net worth. He was like, we never have enough. You should have seen that team of 20 become a team of 1. It's like no one else had ever worked with me before in their life. I'm sitting there and he's like, what do you mean? So telling him net worth is too high. But here we're not talking about net worth, we're talking about the duration net worth. Duration net worth is too high. So I'd be really impressed if anyone can help me with this. So we got to do something with duration assets or something with duration liabilities. If your duration net worth is too high, what do you want to do with duration net worth of assets? Say it again, real loud. Reduce. Decrease. What do you do with duration liabilities? Increase. All right. How do you decrease the duration of assets? Shorter term auto loans, shorter term home equity loans, maybe more credit card loans. How do you increase the duration of asset liabilities? More longer term CDs, those kind of things. Or magic, right? So magic's what we're going to use. But we're going to do the magic on the liability side. How would you increase? Start thinking about this. You want to increase the duration of liabilities. Do you want to be the bank that starts with floating, ends up in fixed, or starts with fixed, it ends up in floating? You want to increase the duration of liabilities. Go from floating to fixed, or fixed to floating. Floating to fixed. Right? So if the bank that started off just regular borrowing and floating, and after the end of the swap, they were at T plus something. Okay. Why do you do this here? It's not part of the question, although you could certainly put it in the question here. And I would, because I ask, discuss what happens. If you put it here, then it's going to set you up a lot better when you do the swap. You're already thinking in those terms and you have it ready to go. All right. It just helps you in the thinking. All right. So I'm going to give you a few minutes. I don't know if any of y'all started on the swap, but start working on the swap. Let's see if y'all can. And can any of y'all do the swap without looking at your notes yet? We'll see. All right. I'd be impressed if you could at this point. All right. What's the first thing you do on this problem? Type what word? Difference. What's the difference here? 240, the difference here, 50. All right. So AAA has the advantage wherever that number is bigger. Where's the number bigger? Fixed rate or floating? Fixed rate. So AAA has the advantage in fixed rate. If the bigger number had been down here, AAA would have the advantage in floating, triple B would have the advantage in fixed. What's going to be the normal situation? Yeah, because of the term structure credit spreads, right? The higher quality ones usually going to have the comparative advantage in fixed rate. That's just a norm. All right, so that's an easy. Now, you can figure out the answer to the swap if you know how to set up the question in advance, because you know the difference in 240 and 50 is what? 190. What's half of 190? 95. So AAA is probably going to end up with what?
Minus 90.
SOFR minus 90, and triple B is probably going to finish up with what? 155. So you somewhat know the answer going in. Don't see the difference, and the difference is 190. You're going to split that evenly. I do set up the problem like that. I'm not saying that's how it actually works in practice. There is a swaps curve. The swaps curve, we're talking the swaps curves based on the average spread of the average company. These are two specific companies that may have slightly different spreads than what the swaps curve is. So it can come out a little different, but I do set it up like that. But show me all your work, all right? So here we know AAA is going to borrow in fixed rate because that's their normal market, T plus 10. Now look at the way I set it up, plus T plus 10. We're talking about the cost. So if they're paying, I do that as a plus. If they're receiving, I do that as a minus. Triple B is going to do what? They're going to do SOFR plus 55. All right. And then we do the swap. AAA receives treasuries, so that's a reduction in their costs, and they receive 100. Triple B is going to pay treasuries and pay 100. And then AAA is going to pay SOFR, and triple B is going to receive SOFR. Y'all set it up like that? That look correct? And then so AAA ends up with plus S minus 90, just like we said. And triple B ends up with plus T plus 155, just like we said. I still set it up like this. You want to see it as a schematic. This isn't the same problem as what we just worked. But AAA is going to borrow, well, we can do it as a problem. So AAA borrowed at what? T plus, whatever, I don't remember what it was. T plus 10, S plus 55. So they borrowed T plus 10. They borrowed S plus 55. They're going to pay S and receive T plus 100. They're going to pay T plus 100 and receive S. You notice there's a third party in there, and that's the investment banker, right? AAA is not going to deal with triple B. They're going to deal with Goldman Sachs or Morgan or Morgan Stanley or JP Morgan. AAA really doesn't care at all about triple B. In fact, triple B could be 3 entities. It could be 1 entity. It could be the futures market. It's going to be whatever is the other side of that. So AAA borrows at T plus 10. They pay the investment bankers SOFR. They receive T plus 100, which is right off the swaps curve. The investment bankers are not out there coming up with a rate. It would take forever, right? If the investment banker, every time they do these transactions, say, oh, what rate am I going to pay versus SOFR? No, they're going to go out and look at the swaps curve, and whatever that number is, that's what they're going to pay. They're going to go look at the swaps curve. If it's 5 years, they're going to go out 5 years. If it's 10 years, whatever they're going to do, they're going to look at that rate, and that is the rate. So when I did my first swap, that's what he was doing. He's looking at the swap curve, and he said, let's wait a few minutes because it's moving in your direction. I said, okay, fine, let's wait a few minutes. So that's essentially what it looks like. We'll talk about AAA being worried about the investment banker, not worried about triple B. That's where their exposure is. All right, any questions on that? That's the magic of this. So in the previous problem, we said they needed to increase the duration or liabilities. They need to be going from floating to fixed. Who is that going to be in this case? Triple B, right? Because they need to reduce, let me say it wrong and y'all tell me what's wrong. Reduce their net worth by increasing their liabilities. Does that sound right? Yeah. Yeah. Any bank out there trying to reduce their net worth by increasing their liabilities? But I get that a lot on the exam. Right. That's the kind of answer I'm looking for. Be complete and be real clear that you're talking about durations. You're not talking about the actual dollar amounts. All right, I'll give you about a minute to do D. D is the easiest question, and it's almost 100%. The one question almost the entire class gets right on the exam, so I'll let you do that one. Pretty straightforward formula. All right. I'm just amazed my phone and this computer at the exact same second. I guess they're all tied to the same thing. Okay, what's the formula here? You remember this one? Pretty simple formula. Exactly, duration of assets times the dollar in assets. Yeah, exactly. Yeah. All right. The duration assets was 425, right? I think 475. 475. And you had $1 billion minus, and the asset liability was 485. So 1350. Does that sound right? And that's not the answer, but that is your dollar duration gap. That's telling you how much dollar duration gap you have, not how much duration gap, but your dollar duration. Now the question is, which swap do you enter into? And this is where you have all kinds. You can do a 5-year duration, 10-year duration, 30-year duration. My first one was a 0 coupon 30 duration swap. So here you have a 10-year duration swap. So what's that called? What's the amount called? We're looking for the what? It's in the question. The notional, yeah, the notional amount that we need. We're not going to actually borrow that money. That's just the number we're going to use to apply the S and the T to. That's going to equal 1350 divided by what? 10, so 135, and so that's your answer. If you took this 135 with 10-year duration and you went up and you added it, and you redid the problem with those numbers, guess what the duration of your net worth would be? Exactly 0, right? I'm not asking y'all to do it on an exam, but you would do that. You'd have to calculate the duration of liabilities by using, just like you do with assets. And then your liabilities dollar amount will now become that 985. So when you do that, you'll come up with exactly a duration of 0. That's what we're trying to do. Essentially, that's all dollar duration gap is doing, is figuring out how much we need to change this and change this such that that equals 0. That's all the problem is doing. But you don't have to worry with that. You just got to give me the 135. And that's exactly what I did at USAA. I calculated our dollar duration gap, got that number 1350, and then my broker says, hey, I got a swap that's got a duration of 30. It's pretty easy. 1350 divided by 30. This is what I need. Now, what if you get a negative number here? Don't worry about it. Do absolute value, right? Because you already know you're going from floating to fixed. If you're going from fixed to floating, it's still 1350. You'll get a negative number, but you don't need a negative. So you're going to tell your broker, hey, I want a floating to fixed swap, and my notional is 135. So whatever you get, dollar duration, think of it as a positive number. You just think, what is that difference in absolute term? Because the floating to fixed you discovered, you determine in part C. All right, any questions on that one? And then here, I don't get great answers on this one. What would I look at? Well, we do eliminate interest rate risk, but we pick up what? Counterparty risk or credit risk, known as counterparty risk. The risk that one party might be receiving from the other party when that party goes insolvent. I mean, that's insolvent. That's the key. Counterparty risk is unlike credit risk. Credit risk is always in one direction. Counterparty risk is these two people are dealing with each other. Sometimes one owes one versus the other. Be nice to add in here. This is usually calculated using value at risk and running scenarios based on historical short-term and long-term interest rates. So usually the way, and what's that called? Say it again. Well, it is stress testing kind of. Value risk is a little different because it's stress testing. So that's a good point when you're talking about your paper. So to me, stress testing is a particular scenario, plus 100 basis points, plus 200 basis points. So here, I don't like that word scenario. So it's not so much stress testing because valued risk is probabilistic. You can't put a probability on stress testing. When you do say, what if interest rates rise 300 basis points? You're not saying what's the probability that happens. You're just saying, hey, what if that happens? That's a stress test. So value risk is actually a statistical. You're actually looking at the distribution and picking a point on it. But what do we call this calculation? It starts with a P, if that helps you. No help yet? Potential exposure. Remember that term? So potential exposure, that's that value risk. You run the distribution, you may pick the 1% point, and that's going to be your potential exposure. How much could they owe you, say 1% of the time, based on how interest rates have moved historically? That's what that is. It's known as usually a historical value risk. There's three types: parametric, historical, and stochastic, but usually using a historical value risk. Just looking at history. That's at USA, that's what we did. I just brought in short-term rates, long-term rates, and I just did calculations and I did it over 14 days. Over a 14-day period, what's the max they could owe me over the collateral that we currently have? Why 14 days? I was just being conservative because, usually, over 2 or 3 days, they're going to give me more collateral as things move. But I just wanted to look and see what that would be. So this isn't exactly the answer, but find some way of putting those pieces in there. I do like you distinguishing between counterparty risk and credit risk. They're not identical. It is a credit risk, but it's a subcategory credit risk that is, when you use it, in an interview or you're talking about counterparty risks, finance people know exactly what you mean. You can't use them interchangeably. If you loan IBM money, you don't talk about that as counterparty risk. That's just credit risk. You loan them money, they may not pay you back. So counterparty risk is related to derivatives, where you have this contract where things can move around every direction, and it's a little bit different number. All right, on a scale of 1 to 10, where if I gave you the exam right now, how would you do? Close the book. Any hundreds? All right, so you got to practice. There are YouTube videos out there with me working these problems. You know, I have this problem as well to work through. The exam's not for a little ways off, so we might work one more of these problems like the week before the exam, just to kind of refresh your memory. But is it a difficult problem? Anyone here is like, wow, this math is too difficult, because if this math is too difficult, you're probably in the wrong major, right? This is pretty simple math. So the concepts are really, I mean, it's pretty cool though, isn't it? Finance does some really, we've discovered some really cool stuff, and have actually improved risk management very well. All right. Let me save this to the right place. Don't you love it when you save something and it's in your download folder and you can never find it again? All right. I want to get to my favorite question. We're going to start this. It may take us a couple of classes, but oh, I love this question. Before we get into the question, I want to show you a really famous, kind of famous article. This guy, Robert Arnott, he wrote an article, and I gave you his actual article as a PDF. There's Robert Arnott, that's a few years ago. Financial Analyst Journal. He was the editor of Financial Analyst Journal for 3 years. He came by UTSA, so I got to talk to him. He's one of my favorite people. I heard him at a conference one year, and I thought, man, this guy's kind of arrogant, but I discovered he's not arrogant. He's actually real humble. He's just not a people, he's just real quiet. He just kind of stays in the background, but incredible speaker. He speaks at a conference, and when he finishes, everybody runs out and radically changes their portfolio. I mean, he's very convincing, very insightful, really brilliant man. He wrote this article called Can We Keep Our Promises? But it's an editorial that he wrote. And I actually told him was that when he came by USA, I said, Mr. Arnott, I got to tell you, the Financial Analyst Journal, and I wasn't like kissing up or anything. This was actually true. The Financial Analyst Journal had never been better than when he was the editor. The articles were so much better. And he was like, thank you. But really impressive guy. But he wrote this article. The problem with this article is I think he wrote it pretty quickly as an editorial. And he uses a lot of jargon. And he uses jargon where he uses 3 terms that mean the same thing and he kind of intersperses them. He's writing this to people who know this really well. So it's a little bit of a difficult article to get to. But if you notice what's right after his article, there's his article, rewritten. I rewrote his article. Not to make it better, but just to make it clear. So he uses the term alpha risk and then he switches and talks about pure risk. You may not know that's the same thing, but he kind of switches around on some of the terms. And probably the biggest thing is I really did not like his graph. I do not like this graph. I think that's way too confusing a way to do it. If he were here, I would, essentially he's a lot more brilliant than I am. But I thought this was a little overkill. So you're going to see how I did it. And I really hope that you will sit down in Excel and see if you can replicate my tape. So what he did is he took a pension plan and took all of its cash flows and graphed them out. And that just gets really complicated. I just use one cash flow to just demonstrate the exact same thing. You'll see how that works. It makes it much simpler. But anyway, so who is Robert Arnott? So he's real important. He's real famous for smart beta. You may know what smart beta is. Would you rather have smart beta or dumb beta? Smart beta sounds good. So he's really famous for fundamental indexing. Have you ever heard of that? Anybody heard of fundamental? Man, it looks like he's getting a little older, right? Anybody know what fundamental indexing is? So my good friend Lance at Victory Capital, he started a fundamental indexing smart beta ETF at Victory Capital. So you know what indexing is, right? The S&P 500 stock index. If Apple is 5% of the market cap at S&P 500, how much does the index put into Apple? 5%. It's based on market cap. Fundamental indexing finds some other way to allocate out. It might be revenue, net income, net worth, some other. So if Apple's revenue is 7% of the revenue of all the stocks in the S&P 500, you put 7% in there. So fundamental indexing uses something besides market cap to allocate. And there's a huge debate, and you should read these. My two favorite writers, these two guys, they go after it. They highly respect each other. In fact, you should go out and read everything Robert Arnott wrote and everything Cliff Asness wrote. They're great. Cliff Asness is pretty cool because he loves really crazy titles to his articles. He tries to find very productive, provocative, and sometimes non-repeatable titles to his articles. He's won many awards. Have y'all heard of Cliff Asness? He's at AQR. You could probably go to AQR and find some really, really good research. It's an excellent, excellent firm. It's a hedge firm. And you can go out. This one's not, he has much more interesting titles than that. But there's Cliff Asness. But these two people, they are in a big fight over this fundamental indexing. Robert Arnott says a smart beta is a smarter way to put an index together. Beta is the market. Alpha is trying to beat the market. Cliff Asness says no. Smart beta is nothing more than another form of value investing. Who does value investing? Warren Buffett. Smart beta is just another form of value investing. It's a really good debate. You could probably find a YouTube video. They go after each other. You'll hear Cliff Asness interviewed where he'll go after Robert Arnott and talk about each other, but they highly respect each other. They are both brilliant. And it's not like Robert Arnott doesn't understand what Cliff Asness is saying. They understand each other. They're both just absolute giants in our industry. I would rather be listening to two of those than reading some of the finance textbooks I've seen going out around here. I remember the textbook we used in my 3013 class. The first time I taught it, I was like, this is a terrible textbook. So this is probably, at this stage in your career, you're probably better off reading their articles or listening to their podcasts than reading textbooks because they're in the middle of the fire of what's going on here. And they're exceptional. They're really, really exceptional. I have high respect for Mr. Arnott. But I did rewrite his article. So this is the rewritten one. So let's, in a nutshell, figure out what he's talking about so we can come back to this. So I'll give you some high level. And the first thing he says is that there's 3 risks investment managers manage. I disagree with him. There's 4 risks. All right, I'm going to add one. But he says 3. You'll see my 4th one. I don't know what I just did. I don't know what order he goes in, but I'll start off with peer risk, or also known as alpha risk. So beta is what investments, what markets that are you in? Are you large company stocks? Are you in growth stocks, value stocks? Are you international stocks, emerging market stocks, and bonds? That's beta risk. Alpha risk is a risk you take by trying to beat the market. All right. So if you go to Vanguard and buy an S&P 500 index fund, how much alpha risk do you have? Essentially 0. You're just buying the market. You're not taking any alpha risk. Alpha risk is trying to beat the market. I had a firm we were looking at on Western Capital or something, I forget the name of it, Westridge. They had t-shirts that said alpha is life. Because what does a hedge fund do? They try to beat the market. Fortunately, we didn't invest with them because it was a big scam and they went out of business. My department was like, I can't believe we're talking to them. So I think our compliance would have figured that out because it was pretty obvious. That's the firm that when UT Austin played USC in the Rose Bowl, they remember that game? Invincible, Vince Young made the touchdown on 4th down, like the greatest game in college football. That was the firm that said, hey, we can get you 50-yard tickets to the Rose Bowl. I said, that'd be great. I'd go to jail if I did that, but yeah, it'd be great if I could accept that free perk. But anyway, so this is the risk you're taking when you're trying to beat the market. It's the risk that you could underperform the market. All right, that's alpha risk. The second one, he says, is asset risk. That's just the risk that assets go up and down in price. Stock market falls like it's been doing the last few days. Pretty straightforward. That's asset risk. The next one he calls is asset liability management risk. That's the risk that your assets and liabilities don't move together. So your assets might be up 10%, but your liabilities are up 20%. So how did you do? Didn't do very well. Your assets might be down 10%, but your liabilities are down 20%. How did you do? You're okay. All right. So this is essentially your net worth, isn't it? You'd like for your assets to be up and your liabilities to be down. That's going to be kind of tough to do, especially since if you want your assets up and your liabilities down, can you do that without risking your assets being down when your liabilities are up? And that's going to be pretty tough. So what do we normally do? We might do something called balance sheet immunization, right? Have you ever heard that term? That's something we just did with the bank, didn't we? We want to make sure our assets and liabilities were lined up by matching the duration. So that's ALM risk, all right? Which of these three is the most significant risk, the biggest risk, the one that drives earnings and net worth the most? Yeah, this is like the majority of the risk by far. Which of these is the smallest risk of all?
No one. No one.
Yeah, smallest risk by far. Where does the industry put most of its effort? 99% of its effort. Where does the industry put 99% of its time and effort in? Yeah, 99% of time and effort. How much time they spend on ALM risk? 0% effort. Why is that? I said there's 4 risks and I'm only giving you 3. Why do we spend 99% of our time on the smallest risk and 0% of our time on the most important risk? What do you think that is? Have you heard of this word? Incentives. How is our industry paid? They paid for managing ALM risk. They paid for managing alpha risk. So what is that 4th risk? It's called career risk. That's the risk you get fired. How do you get fired in finance? You get fired in finance by being different than everybody else. As long as you follow the herd and do what everybody else is doing, you're fine. We have an industry that encourages you to follow, because what are you trying to do? You're trying to keep your clients' money. How do you keep your clients' money? You make sure you're not too far off from everybody else. If you're up 6% and all your competitors are up 12%, what's your client going to do? They're going to fire you and go to the competitor. If you're down 10% and all your competitors are down 10%, what's your client going to do? It's like, well, not much we can do, right? Everybody's down 10. We're fine. If you don't believe it, let me tell you the story of one hedge fund came in. They This guy was so happy. Man, what is he so happy about? He comes in, man, we love days like this. He even said that. We love meetings like this. We love good meetings like this. So he comes in, I say, okay, well, how'd y'all do? He's like, yeah, we're down 20%. It's like, oh, okay, you lost a fifth of my money. Now, why was he so happy he was down 20%? Everybody else was down 25 to 30%. He goes, yeah, man, this is great. Look how we did. I go, yeah, but you lost a fifth of our money. And this is, I kid you not. He goes, oh, yeah, that. What business are you in that you're excited you lost a fifth of my money? Do you know any other business? Your plumber says, hey, you know what? I just flooded your house, but if you'd hired our competitors, they would have flooded it worse. So I just want to give you that good news. Just calling you up, you know, your whole downstairs is flooded, but man, if you'd hired anyone else, they would have flooded upstairs too. And just really happy to tell you that news. Now, our industry loves giving bad news if everybody else is worse. And it's like, man, there's something wrong with this industry. But that's the career risk. It is a risk that says, keep your client. The way you keep your client is by doing what everybody else out there is doing, even if that makes no sense whatsoever. This is what we should care about. This is what we care about. Why? Because that's how the industry is paid. Because the industry is paid that way, that's how we focus our effort. And how good are we at this anyway? How good is finance at beating market indices? We lose about 85, 95% of the time. Why? Because our expenses are so high. What is Jack Bogle at Vanguard, what did he say? The key is expenses. Keep your expenses low and you will beat the market. That's the key. So you might say, hey, we can beat the market by 50 basis points on average. But if you charge 100 basis points, you're losing. What does Jack Bogle do at Vanguard? I don't know. Do y'all know the story of Vanguard? So when Jack Bogle started Vanguard, he wanted to charge really low fees, like practically zero, and just give everybody the index. We had a S&P 500 index fund at UTSA would charge 1 basis point, 0.0001, almost nothing, almost for free. Guess what happened to Jack Bogle in the 70s? He got sued. Industry says, that's not fair. You can't charge that little. Isn't that a great industry? When you want to come in and be the low cost provider and all your competitors sue you because that's just not fair. You can't be low cost. He won the lawsuit, fortunately, but that's kind of industry you're walking into. It kind of like doesn't care about its customers as much as it cares about its payroll. So he doesn't put that in there. He kind of implies, but you have to kind of figure out why is that the case? Why do we spend so much time on the smallest risk? It's because that's the way we're paid. All right. This gets me to one of my quotes, one of my strange quotes. This one probably won't work on a t-shirt, but if someone's got a gun to your head, it's not the time to be worried about your cholesterol level. Now, what does that mean? We'll get into it later, but what is the industry doing? It's worried about all the wrong things. The thing here, though, is it's our industry that's playing Russian roulette with our client, but we're pointing the gun at our client. And we keep pulling the trigger and no bullet comes out. We're saying, see, everything's good. In Russian roulette, every time you pull the trigger and a bullet doesn't come out, what happens to your risk? Is it going up or going down? It's going up, right? What does our industry say? Hey, look how safe we are. Nothing's happened yet. So it's just the way our industry is structured. What does that mean? You can jump into this, make a lot of money and just ignore that fact, or you can find a company that's on the right side of this equation. And there are some out there. So most of the effort should be here because that is the biggest risk. Most of the effort is actually here. Firms do spend a little time on this. Essentially what they do is once a year, they look at their policy, say, do we need to change anything? And they say, no, everything's fine, and are done. So it's like a 10-minute conversation once a year. There's just not much effort put on the asset risk. And that's just, say we have 70% in stocks, 60% in stocks. Says, let's just say it's 70, that's fine. All right. So there's the 4 risks. And what Arnott's going to say, I disagree with him, but I think if he was here, I think he would agree with me. So he's given a politically acceptable answer versus giving the right answer. So I came into this a little bit skewed in my thinking because I worked in a life insurance company when I started. And John Woosley, my life insurance actuary friend, boy, I learned something. You're going to have to find your John Woosley. in your first job. How do you know who it is? It's pretty simple. You're sitting in a committee meeting and someone asks a really technical question and the whole room will turn and look at John. That needs to be your best friend. You need to take that person to lunch or whatever. So John was like, I won't say my best friend. I mean, he was like a lot smarter than I was, and he was just kind of like tolerating me. But he loved talking to me because he was doing really impressive stuff and no one knew it because he was so smart, much smarter than everybody else. And here he had this little kid like, wow, you're so smart. That's so, and he would dumb stuff down for me. But when I became responsible for USA's pension plan, I go, okay, John, I got a question for you. I've got a pension plan that looks a lot like the life insurance company. It's a liability. It's very sensitive to interest rates. You're 100% allocated to bonds. We're 70% allocated to stocks. What gives? This is a guy I have a lot of respect for, very, very smart. I used to call him Fast Talking John because he spoke like that. So I would finish his sentences even I had no idea what he's about to say. So I'm a real hyper person trying, but I'm going to sit there and patiently listen to him. And he goes, well, the problem is you guys on the pension side are idiots. You don't know what you're doing. We know what we're doing. So it's kind of like this debate between, AT&T and me, and then him telling me, and I respect this guy highly. The whole industry is doing this 60, 70% in stocks. And he's telling me, you guys don't know what you're doing. That's absolute insanity what you guys are doing. That got me thinking, like, maybe we need to radically rethink what we're doing and think differently. That contradicts with what? If I say we're going to do stuff a lot different than everybody else, what risk am I taking? Career risk, right? Actually, significant fiduciary risk. Because I can get sued managing the pension plan by the employees of USAA. As long as I'm doing what everybody else is doing, I'm pretty safe. So I'm actually here now starting to take some personal risk here that I'm going to try and do stuff that everybody else is doing. So what Arnott is going to argue is we should put some time into this. My solution you're going to see is, I mean, it's pretty crazy. My solution was ignore that entirely and only do number 4. Pretty radical. All right. Not only is it pretty radical, so I can tell you in 2008, the 1,000 largest pension plans, there was one pension plan who actually had a gain in 2008. Every other 999 of them went from a surplus to a deficit in 2008. Only one. You want to guess which plan did? So we went radical and it worked in 2008. Now you might say it hasn't worked since because stock market's up a bunch. We'll talk about that. I decided, this was my proposal. It took me a long time to get it approved, to put 100% of our time on number 4, which is essentially what the life insurance actuary said they do, and ignore peer risk, ignore asset risk. Let's focus entirely on that one. Arnott says you can eliminate a big part of this risk by just doing one thing, and that is take the most sensitive part of your pension liability and hedge that away with interest rate swaps. And we're going to look at his math. I think he would agree with me that we should just focus on number 4, but he also knows the industry is absolutely set up to do that and that you couldn't go out and propose quite that radical. So I do want you this weekend, you can read the rewritten one. Here's the risk, peer risk, asset liability management risk, but I add in the career risk. He talks about the size of the different risk, and ALM risk is actually much larger than what he's showing here. This figure here, try to figure it out. You should be able to replicate this. This is actually the key to this whole article. And what we're going to do is we're going to take from this, and I'm going to make my argument that my solution increases the value of the firm. Arnott's solution increases it some. I think my solution increases it a dramatic amount. And I think the AT&T solution destroys the value of the firm. And I'm going to walk you through that. That's not in this article. This article kind of sets it up. But I do want you to try to figure out this. You should be able to very simply recreate this chart. So see if you can look at it. And then look at his solution. His solution, it has to do with the long-term part of the liability, the most interest rate sensitive part of the liabilities. let's at least hedge that piece. So his bottom line solution is you take 10% of your liability and hedge it, you can eliminate 60-70% of your risk. My solution is let's hedge the whole thing and get all the risks taken care of. But he says, let's at least get rid of 50-60% of that risk. All right, y'all see where these articles are. I am going to walk through these articles, but then my main thing is this PowerPoint, the borrowing to invest. If you load that, the link to my blog is right at the beginning of it. So we'll work on that. All right, we'll stop it there.